So let's talk trends. Now, the risk of stating the obvious, a trend is one of the most powerful things in trading. Now, we see it all the time in textbooks, people saying it, the trend is your friend, except for the bend at the end, all these kind of other things. But honestly, a trend is so forgiving of a poor entry. If you can get on board a trend at the right place and you've got a wide enough stop, as long as that trend's in place, you will make money. Now, that sounds like a really broad statement, but it is ultimately true. So, how are we supposed to trade trends? Now, that is obviously really oversimplifying it. Really oversimplifying it. If it was that easy, maybe we'd all be rolling around with billion-dollar accounts. But it's not that easy. However, we can still utilize and leverage on the fact that the market is really in one way or another. A lot more supply coming in, a lot more demand coming in. So let's talk about exactly how to try and align ourselves with the trend. A couple of tips. The first one is just use the most simple of indicators. If you're using a 5 period moving average, a 10 period moving average, a 50 period moving average, in fact, let's move to a 50, and I know this one's a 20. You can kind of say to yourself, listen, obviously this is now an uptrend. We can see this is an uptrend. We can visualize it. We can draw on trend lines. We can do all those kind of things. But what we do not want to be doing, now this could be a daily chart, could be a 1 minute, it happens to be a daily. But what we do not want to be doing is just diving straight in blindly, because the danger is we dive in, especially if we're trading on margin, we're trading leveraged up, it pulls back a little bit, we end up getting caught out, we end up making a loss on what is actually a relatively obvious trend. So what's an easy way of at least filtering out getting involved in bad trades? Well, the first thing is just do not get involved when the market is extremely stretched. So what I'm going to do is I'm going to flip this 50 to a 5. And in fact, what I'll do is I will also thicken it up a little bit, and let's brighten it up a little bit just for the sake of this video so we can see what's going on. Right, so the 5 period and the 20 period, quite tight moving averages, but what they're going to do is it's going to give you a guide as to when to get involved with the market. The idea being that when that 5 period moving average is too far away from the 20 period moving average, you don't get involved. You only get involved when it's almost touching or it's very close. Now, the reason is because generally speaking, even if you've got a market in a trend, it's going to oscillate like this. Very rarely is it going to do this, and if it does, that's fine. It will pull back at some point. You are far better waiting for the spring to unwind, for everything to compress, and for everyone who's trapped short, everyone who wants to get on board, to then help guide you with the push back up. So trends are scrappy. They're not obvious like this, and you're buying every pullback and everything's a winner and buying every breakout. It doesn't work like that. In actual fact, great example here with Netflix, if you're buying breakouts at the wrong position, you actually get involved in fake outs. So you've got to be careful what you're doing. So what I would always suggest with a trend is, listen, if it's an uptrend, fine. Just remember where the price is. Never chase a trend. If we go to something like the Dow Cash, Dow Cash is a great example because it's not it's not stock specific, obviously. It's just based on a broad sentiment. If you use this strategy of not getting involved until the price or the lower moving average is close to the high moving average, you're not going to get caught out. Okay, you're going to end up missing moves like this, which is fine, but it means you're getting involved long at areas of this kind of area, and then you're not. There's no heat on that. There's no heat whatsoever. Then you can be on board when it starts to progress high. Obviously, if you're getting involved when it's stretched, look at the heat you're taking. Now, yes, of course, trends are going to pull back. They're going to consolidate lower. They're going to test. They're going to probe. They're going to do all sorts of things to the downside. And even if you're getting involved around here, you can still be wrong. But ultimately, what it does is it keeps you from getting involved in a stretched environment. Now, one caveat to that is to say, listen, if you are getting involved in the trend when it's stretched, by all means, but be very cautious with your stop. This, for example, good strong move, bull flag, by all means get involved with this, but don't treat it as a broader trend play. It's a mistake a lot of people make, is that they say, okay, it's an uptrend, I want to treat it as a trend play. They get long here, and then they end up having a stop, kind of down here, and really that's the place you want to get involved in. If you're getting involved in this extreme tight second leg kind of play, first leg consolidation, then use a tight stop recognize that the strength is there. It's a momentum play more than a trend play. A trend play is much more aligned with taking it when it comes back to the mean. So when the market's unwound a little bit, found a little bit of a breather, got a little bit of a breather, whether that is on a daily, whether it is on a 5 minute, a 15 minute, whatever it may be, and then getting involved for the second, third, fourth, fifth legs, again, whatever you're looking for as a trader. Even though you're trading with the trend, this is more of a momentum play, and being very strict and structured with your stops will save you. You can also go back in if it stops you out when it unwinds and comes back to a kind of mean area, but it's taking it when it's stretched, buying it at highs. You sometimes look at the chart and think, well, yeah, if I buy after 3 days high, I've got away with it. But it's very rare that you're going to get that constant move in the same direction without some sort of pullback. So your job is, number one, to identify the trend, and number two, to identify a good place to get involved in the trend. Now, obviously, if the trend reverses after you get in, so what? That's what happens. That's life, and that's why we manage our risk and why we use a stop loss. But by the very nature of a trend is that it won't reverse unless it's at the end, obviously. So just literally taking the probabilities in play. If you've got an uptrend, it's going to carry on higher and higher every time it pulls back, multiple times before it eventually reaches the top, as long as the area you're getting involved in isn't too close to the high and you're not getting stopped out on what is just a pullback. So in other words, summarizing it, just get involved on the pullback, use your stop an extra width under that pullback, and then get involved, because you've got more probability on your side then. It's a simplistic way of looking at it, appreciate that, but if you can extrapolate that almost into your day trading as well and say, listen, we're on day 4 of a pullback in an uptrend. Now I'm going to look for longs, I'm going to look for double bottoms, I'm going to look for bottoming patterns in the market. You're aligning yourself on the higher time frame trend, but then drilling down onto a short time frame to use a day trading strategy. Vice versa. Let's say you've been up for 5 or 6 days in a row. Maybe you want to step back. You say, listen, I don't want to trade this from the long side because I feel it's stretched. I want to wait for it to come back to the mean. Perhaps you don't even trade that market until it comes back to a mean area. Perhaps you say, you know what, I'm going to try a little sneaky short on a day trading perspective only. Obviously, shorting in a brutal uptrend is very risky. Works on a day trading perspective if you're very careful where you do it. That's another video. But generally speaking, if you can align yourself with the broader trend, then you're doing yourself a big favor. And I know it's simplistic and I know it's overdone, but if you just look at the probability and just look at the way that markets move in trends and how strong they potentially can be, it makes perfect sense from a trader's perspective to align yourself with that supply-demand imbalance.